All right. Welcome, everyone, to the webinar for Flats at Stones Crossing. First off, want to say appreciate you taking the time out of your Sunday evening to spend it with us, with myself, to learn about Flats at Stones Crossing. Really excited about it. It's the latest investment opportunity from Great Capital. It's been a long time since Great Capital's had a deal. The last time we closed on a project was about a year ago for Salon at the Crossing. We did pursue another deal earlier this year, but we found some things in due diligence that did not allow us to pursue and actually close on that deal. Now, Flats is even more compelling than that previous opportunity. Showing you a little bit of some of the drone footage. It's an incredible asset. 2024 construction, 292 units. So today I'm excited to tell you about the property, why we're so compelled to invest in it. But first, I'm going to tell you a little bit about Great Capital, why we think investing in multifamily right now makes a lot of sense, and then get into the market itself, from the Midwest to Indianapolis to Greenwood to Center Grove, then getting into the property itself, Flats at Stones Crossing, the demographics, the details, and then our business plan on how we're going to drive revenue and returns at the property itself. So let's just start jumping right in to Flats at Stones Crossing. In addition to just going through the details of the property, I am going to be going into our financial model for the property itself closer to the end of the presentation, where we're going to be stress testing the deal, because we're confident that our assumptions are conservative, they're really the realistic, but things go wrong. The plan doesn't always go according to plan, and so we want to be prepared. And this isn't the first deal. We've had over 11 full cycle projects at Great Capital. We have over 17 active investments, and so we've had bumps in the road. We've had to adapt, and so we're going to go through some of the risks and how we may adapt when we face those challenges later on. So, all right, let's jump right into talking about Great Capital. And what makes Great Capital an incredible organization is not that our successful investments, it's our people. So just right here, we have just a chart of some of the key leaders at Great Capital itself, starting with myself, my wife, Alex, and the rest of the Great Capital team. Great Capital, we're based out of Indianapolis, started the firm back in 2015 with my wife, Alex, after we sold a business. But I've been investing in real estate really since 2006, started fixing and flipping small rentals. After we sold that business, started getting into buy and hold multifamily. From the beginning, we thought that the best strategy was buying stable, solid multifamily assets that are cash flowing, not taking on too much risk, looking opportunities to force appreciation, add revenue, create value, but then using fixed rate financing and holding for a relatively longer period of time to eliminate potential risks and ensure our chance of success. Because the first key is we just don't want to lose, but we have to preserve capital. We have to preserve principal. That's the first, the second rule of what we do here at Great Capital. We've never had to issue a capital call. That's been unplanned. We've had a fund where we've had capital calls, but we've never had an unplanned capital call. We've also never had to use any kind of rescue preferred equity or rescue debt or any kind of rescue financing. The reason for that is all of our deals are cash flowing. Our next loan maturity is until 2027, and we'll most likely sell that asset for a profit or refinance. We absolutely believe in operational excellence. We're not using third-party management. We do most of the work ourselves. We do pretty much everything in-house. We believe in having the best people combined with the best technology, the best policies, and really just leading with empathy, compassion, but also just a high level of professionalism that allows us to treat our team members right, and also all the way down to the resident itself. We have some current investors on this call. We tried to do our best to treat our investors with respect, give them the proper time that everybody needs in terms of communication and reporting. But we treat our residents at these communities the same way. We want folks to come back. We want high renewal rates. And in general, we want to do things the right way. And we feel that property management has really degraded over the last decade or so, certainly since COVID. And we want to reverse course. We want to show value. We want residents to see there's a reason to renew and that they're all right when their rent goes up, is they're seeing that value. We're based out of Indianapolis, as I mentioned. We really only buy properties in the Midwest, in our backyard, in areas of the country that we know. We don't really buy anything outside of a 4-hour radius. Our target states are Indiana, Ohio, Kentucky, and Michigan. We predominantly focus on value add projects and core plus, typically newer assets that were built, after the mid 90s. We're looking for minimal functional obsolescence, something that, again, our target demographic of Gen Z and millennials or empty nesters are going to find appealing. And we're targeting markets with high median area incomes, folks that are easily going to be able to afford these apartments and be able to afford some of the upgrades that we do once we actually acquire them. The last thing is we are aligning our interests by having skin in the game. Our average co-investment for our investments is over 14%. Flats at Stones Crossing, it's well above 10%. That's the only way to truly align interests. We can move fees around and profit splits, and we try to make those as favorable to our partners as possible. But the only truly way for you and I to be on the same page is if our dollars are being treated the same and we both have the same amount to lose. And in fact, really the GP and Great Capital, we have much more to lose from our hard-earned dollars, our reputation. What we want the most is a successful investment and outcome for everyone. Just as a quick example, before we get into flats at Stones Crossing, I want to take a look at a quick case study. Villas on Fur. It's a multifamily property up in Granger, Indiana. That's right next to South Bend, near Notre Dame. We bought this property kind of right in the middle of COVID in 2020. In a time not too dissimilar than today. It's uncertain, not sure what the next year is going to look like, not sure where rates are going to go. Again, this was the heart of the pandemic. We acquired a new asset. At the time, it was built in 2017. This was 2020, so it was only 3 years old. And again, people weren't sure where the market was going. We saw an opportunity where there was value. We could increase revenue by reducing concessions, reducing some other expenses, and eventually driving rents over time. Not only were we able to do that, we were able to put an incredible loan and refinance it after owning it over for just a year. We locked in a 2.7% fixed rate loan for a 35-year term, 35-year amortization, and that property over the last couple of years has been cash flowing 15% annualized returns every single year for the last 3 years. Now, not every project is like Villas on Fur. It's a unique opportunity, but again, when many investors take a look at villas, they say they see a new A-class property. They don't necessarily see a deal that's going to have high cash flow. Again, I'm not saying Flats at Stones Crossing is going to be delivering 15% cash on cash returns, but a lot of our business plans are very similar at Flats than Villas on Fur. And really what I'm trying to express is that we have the operational experience and the capacity to manage a large A-class asset with high income renters well, and we've really excelled at it. Now, our track record, I think, speaks for itself. Done a lot of deals, still have a lot of active projects, but on our full cycle projects, we've achieved an average IRR of over 28%, and all of our current projects are cash flowing. Every single one. Again, we've never had to make a capital call. Not that we haven't had bumps in the road. Not that we have not had to suspend distributions at some sites in the past. But at least right now, today, and for over the last 2 years, we've been able to maintain consistent distributions across all of our sites. And that's because we're in the weeds, managing these properties, looking ways to cut costs, drive revenue, and just do things better, because the way that we manage properties 5, 7, 10 years ago is not the way that they can be managed today. It's a different game. Again, technology's changed and the workforce has changed considerably. Before we get into the deal, if you've already watched our deal preview video, you've looked at due diligence materials, if you're all ready to jump in and make your commitment to Flats at Stones Crossing, they just want to let you know you can go ahead and do that right now. I've put a link in the chat window, but also if you're watching this on TV, you can take your phone and scan the QR code to either schedule a meeting with the Great Capital team or access the deal room on our portal, where you can access due diligence materials, the deck, partnership documents, and you can actually fill out all of your subscription agreement and partnership docs on the portal, set up your bank account to make your commitment all in one place. And if you need to be walked through how to do that, it's simple. It takes about 5 minutes, but scheduled meeting, we'll walk you through step by step. All right. Why multifamily, though? I've talked to some institutional investors who don't do real estate every day. They're not living and breathing it like we are, and they say, man, multifamily isn't it really struggling right now? I thought multifamily just wasn't doing well. It's still overpriced. The rents aren't growing, and there's just a lot of noise. Now, what's true is multifamily in the Midwest is not multifamily just anywhere in the United States. The nuance matters, and where and what you're buying matters more now than it ever has before. You can't just go into a random market and buy a multifamily deal and hope that you're going to cash flow it and do well at the end. In fact, there's a big difference between the way we buy multifamily, which is again buying a stabilized, cash flowing asset with fixed rate debt. That's completely different than buying an older, 70s, 60s vintage property on a floating rate bridge loan, trying to throw a bunch of money at it to try to get $400 rent premiums over a short period of time to then refinance or sell within a year. It's a completely different investment strategy. It's like comparing buying, a blue chip stock, the Mag 7 or, Apple or, any blue chip stock. You're comparing that to, buying penny stocks or trading options. They may be public securities, they may be stocks, they may be the similar asset class, but the strategy couldn't be more different. We focus, again, on capital preservation, cash flow, and strong markets, and long-term holds. We're not looking to get rich quick. This is not for investors investing $5,000, $15,000, $25,000, or even $50,000. This is for folks who are looking for stabilized, stable income at a strong property that's going to appreciate over time. And they're trusting great capital to manage that investment for them. So why multifamily? Doesn't make sense right now. I think we're in an incredibly unique opportunity where there is a lot of shade on real estate right now. Interest rates are up. Doesn't seem like it makes sense. No one's really sure how housing is supposed to work. I mean, single family homes are broken. You can see on this chart the monthly mortgage rates versus rent payments are completely out of whack. It is so expensive to buy a single family home to be able to afford that mortgage and have the down payment to do it. So many individuals, they're no longer renters by choice of where they could rent or they could buy. They're renters by necessity now. And they might be making really good incomes. I'm talking six-figure incomes, but you might not be able to buy that house. That means there's a larger pool of renters for longer than we had ever anticipated. Additionally, home price to rent to income ratios, actually the rent to income ratios have come in line. We did see strong rent growth back in 2021 and the first half of 2022, but wages have been growing since then. And nationally, maybe not in the Midwest, but nationally rents have declined, wages have kept up, and we're actually in a sweet spot where we could see some organic rent growth in the future. But why we haven't seen that yet is because of all the new supply. We hit about a 40-year peak of new supply deliveries in the United States last year in 2024. While each market is different, we have passed that wave of supply and are now seeing receding levels of supply. Indianapolis is one of those markets that is going to have much less supply over the next several years as we've seen over the past few. Just looking at this chart, and this is a national chart that breaks down the different regions, Midwest, South, Northeast, and West, and you can see the huge rise between 2023 through 2024, but you can also see how we're dropping precipitously. Again, Indianapolis is going to see a trickle of new deliveries over the next couple of years, and same with our submarket in Greenwood, Indiana as well. A lot of positive momentum for the multifamily. Paying attention recently this last week, it looks like we are going to see a potential rate cut at the September FOMC meeting. Generally, if interest rates start moving if they do start moving lower, which we're not necessarily anticipating or baking into our model, but if they do, we would likely see some cap rate compression as well. And looking at some of the public market data, we're already seeing some of that take place. A lot of interest in some of the apartment REITs already. And it's a good reminder that apartments typically outperform and deliver alpha following recessions, the pandemic, and whatever you want to call the last several years. Real estate has technically been out of favor the last few. Now is the time to get into real estate, especially multifamily, when others are looking elsewhere, but the fundamentals couldn't be more clear. this is talking about cap rates. Cap rates are actually already started to compress. And we saw prices decline in multifamily between 15 and 30% from the peak at the second half of 2022. We've already starting to see those cap rates really plateau and start to come down slightly. And again, if we do see lower interest rates over the next several years, we would likely to see cap rates either remain where they are today or move lower bound. In Indianapolis, we've seen Class A properties over the last year trade for sub 5% cap rates. I think we're getting a good deal on flats at Stones Crossing. We're buying it for a 5.5% cap rate. But again, if we see treasuries even stay where they are or move lower, A-class, premium, institutional class assets most likely will be trading closer to that 5% range rather than closer to 5.5 to 6. Again, just a couple of years ago, institutional class, multifamily properties in Indianapolis and the Midwest were trading closer to a 4 cap. And multifamily remains, compared to all other commercial real estate, the most liquid asset class. So even with higher interest rates, even with tariffs and uncertainty, multifamily investment has stayed stable and robust. But why the Midwest? We always hear the Sun Belt is an incredible region to invest in because there's population growth, there's employment growth. The Midwest is truly a sweet spot. Frankly, I used to take it for granted because I'm from Indianapolis. I grew up and was raised in the Midwest. Thought I had a little bit of home country bias. There have to be better places to invest, and there probably are some really good other places to invest. I've looked in the Southwest. I've looked in the Sun Belt. I've looked in Texas. I've looked in Florida. Part is I'm never going to understand those markets the way I understand my hometown of Indianapolis and similar cities that resemble Indianapolis, like Columbus, Ohio, or Cincinnati, Lansing, Michigan, or even Kansas City. But it turns out, especially over the last couple of years, Indianapolis has some incredible fundamentals. And we're just at the early stages of, I think, a whole new cycle of growth for many Midwestern cities, especially Indianapolis. Over time, the Midwest markets have remained more stable, having higher occupancy and generally lower volatility. Rent growth has projected to remain positive and has remained positive throughout the pandemic. Even when most other markets remain negative, Midwestern markets have remained positive rent growth over the last several years. If you look back to COVID, when there were job losses across the country, Indianapolis had the second least amount of job losses, following just by Salt Lake City was the only other market that had fewer job losses than Indianapolis. And as we are entering a new era of manufacturing in the United States, reshoring, the Midwest is where you want to be. That's where all the new jobs are going to be coming in, and it's not speculation. It's happening right now. If you live in Indianapolis, you subscribe to the IBJ or any of the business magazines, you're seeing all of these announcements happen every single week. And especially with manufacturing. And what's exciting about manufacturing is, and again, Indiana has some of the highest percentage of workforce in manufacturing compared to any other state in the country. But what's great about manufacturing jobs is for every one durable manufacturing jobs, it creates 7.4 new jobs in other industries. So that blows out any other industry out of the water for the overall impact to the local economy the manufacturing has. In Indianapolis and Indiana, it's not just manufacturing, it's a diversified economy. But when that macro trend is occurring, it's a force that we want to get behind. Another thing is logistics. Indianapolis, the Midwest, but Indianapolis is the crossroads of America. Logistics are a core part of our economy, between having more interstates coming through Indianapolis than any other major market, being able to ship goods to 80% of the U.S. population within a day's drive. We are the second largest FedEx hub in the world and a major CSX regional rail center as well. And future infrastructure is going to be driving more of that growth in Indianapolis. All right. Let's talk about the deal a little bit. Let's talk about flats at Stones Crossing. Specifically, let's get into some of the market, Indianapolis, and some of the details. Strong population growth since 2010, moderate home values, home of the Indy 500, the Pacers, the Fever. home of great capital. It's also home to companies such as Eli Lilly and multiple healthcare companies, IU Health, Community Health, logistics firms. Again, I mentioned FedEx, CSX. We're also, obviously, Indianapolis is the capital of Indiana as well. Very diversified economy. Education, administrative, finance, manufacturing, IT, healthcare. Indianapolis has it all. We're diversified, which has allowed us to have relatively low volatility even in periods of economic uncertainty. All right, let's go down a little bit south. We're getting closer into Johnson County, which is where Flats at Stones Crossing is located. Since 2024, rent growth was at 6.4%. It's come down a little bit since then, but it was really rocking late last year. Average occupancy in Johnson County is about 93%, but it's experiencing incredible population growth. The northern suburbs of Indianapolis are some of the absolute most affluent, but man, it's expensive to live up in Carmel, Fishers, and Noblesville. So a lot of people, when they're moving to Indianapolis or when they're looking to relocate around Indianapolis and they're looking for a suburban environment, they're looking at Johnson County and they're looking at the south side, but they're driven by affordability. That's why since 2020, Johnson County has seen 4.8% population growth, and since 2010, there's been a 21.7% population growth. Zooming in a little bit more, Greenwood, Indiana, which is technically the city that Flats at Stones Crossing is in, experienced 5.6% average rent growth since 2020, 33% population growth since 2010. You'll notice as we zoom in, the numbers get even better, which is what you want to see. Median home value is about $376,000, and household income is about $85,000. All right, Center Grove. We're getting really close to Flats at Stones Crossing. 1.3% annual population growth. 119% population growth since 2010. Median home value of $399,000. Median household income of $95K. An average household income of $127,000. This is a great market. It's a really strong submarket, highly affluent, high incomes. Center Grove schools are some of the best schools in Indianapolis, really some of the best schools in Indiana. Center Grove High School is a massive facility that attracts students really from around central Indiana. And there's only so many apartment communities in Center Grove schools. A lot of the newer competition is not in Center Grove, it's actually outside. So again, we're rapidly growing. This is some of the population growth charts. And again, hop onto the deck, which is linked via the link in the chat. And we can access all of these materials. And on the Great Capital portal, we have all this information and a lot more due diligence information for you to go over as well. Strong income, home values, really strong. Flats at Stones Crossing is located between I-69 and I-65, really right on the State Road I-35 corridor, which is the primary retail corridor through the area. Grocery stores, shopping, Home Depot, there's a Kroger, a new Meijer supermarket is going in, and really Flats at Stones Crossing is the center of a planned development that's called Schwartz Crossing, where there's multiple brand new retail coming in just right across the street and immediately adjacent to Flats at Stones Crossing. Sometimes we joke in commercial real estate that, we kind of piggyback our demographic research off of, much larger firms. But when we see like a retailer like Meijer going in right down the street, basically a stone's throw, that gives us confidence and conviction that the demographics are moving in the right direction. Although it doesn't really take much guessing, we just went over the data. The population growth is just absolutely off the charts. Occupancy, this is an updated occupancy number for the property itself. We got new July financials at the end of last week that I'm going to go into here in a little bit. The property is currently occupied at 95.5. You may have seen previous videos or previous messages where the property was occupied at 94%. This is really good news, especially kind of late in the season. We're getting outside of our leasing season. School has already started. And so the property is more than fully occupied and beyond stabilization. When you look at this chart, it starts to tell a little bit of the story So I mentioned Flats at Stones Crossing was built in, the last unit was delivered in 2024. The first unit was delivered in 2023. As you see, they were they had to lease the community up. During that lease up process, they had to issue concessions at the property. They raised rents, they lowered rents. And eventually it was able to get fully occupied. I think that was one of the reasons why we were able to tie up Flats at Stones Crossing, is because when we started pursuing it, it wasn't fully leased up. Now, we needed to wait until they had a long enough of stabilization to where we felt comfortable in its trajectory, as well as our lender, Freddie Mac, felt comfortable enough to start issuing financing. We have to have enough stabilization to put a long-term fixed rate loan in place. And fortunately, we were able to do that, and they've been able to maintain that positive momentum. Looking further at the market, you can see that, now this is Indianapolis under construction. We're starting to see supply has been dropping off since really early 2024. And even though we've been in this period of high rates of deliveries, Flats at Stones Crossing has been able to maintain momentum and has been able to raise rents year over year, increasing their rents when they have traded out leases. They've been able to trade out some leases for a 5% rent bump, especially when you look at the whole rent roll from last year compared to this year. So moving in the right direction. Now, there's one property that's under construction in this submarket. It's going to be delivering about 280 units in the latter half of 2026. But that's the only construction project that is known about in the entire Johnson County submarket. So there's 280 units coming on at some point. We just delivered a little bit closer to 1,000 units over the last couple of years. The property was able to absorb that. It's winding down concessions. And currently, you can see that the submarket has been absorbing as much as 250 units just given a single quarter. So 200, maybe up to 300 units coming online over the next couple of years. When we're absorbing 200 units a quarter right now, is really a drop in the bucket. And when we see that mismatch of supply and demand, that is the primary leading indicator of future rent growth. Okay, let's get into the property. Now, I'm going to repeatedly show this slide just to remind you some of the high-level deal highlights. Keep in mind, we are offering an 8% preferred return, an 80-20 LP-GP split with no additional waterfall. We're looking at a 5-year hold on the investment, and our current underwriting is projecting a 17% internal rate of return, a 2x equity multiple, and cash on cash averaging 7%. Although here in a little bit, we're going to get into the model and really kind of stretch some of those assumptions and look at the whole range of possibilities and what it would take to really break the deal. Getting into the property itself. It's a beautiful asset. The resort style pool, grilling stations, bocce ball, everything you'd like to see. A really nice looking leasing center, an aqua lounge over there to the left you can see. And then this is a list in some pictures of all of the community amenities on the site. And this really allows us to compete and be on par with the competition. But I think we can do more. But you can see here, great pool deck, fire pit, the aqua lounge. We can mention the bocce ball, great fitness center. There is a dog park. The units look great. Your 9-foot vaulted ceilings, patios with storage, GE appliances, built-in washers and dryers that are included. Really nice LVT plank flooring. Really just a very attractive units and a variety of attractive floor plans as well. The breakdown of the unit mix itself, it's basically 50% twos, 50% ones, and specifically 2 beds, 2 baths, and 1 beds, 1 baths, with only 4% 3 beds and 2 baths, and skewing a little bit to the 2 beds and 2 baths. As you can see, the average rent at the property is $1,600. Again, $1,600 for a brand new Class A property, I think is pretty cheap. And we look at some of the comps that's going to confirm that assumption. Again, if this was up in the northern suburbs or this is in other markets, this average rent would be closer to $2,000 and looking at it at $2 a square foot versus $1.65. This is just an example of the floor plans. All the floor plans are named after stones, flats at Stones Crossings. We've got the citrine, the carnelian, the quartz, the amethyst, topaz, jasper, lapis, opal, the garnet. A variety of really attractive floor plans. Our team has been in every single unit at the property. It's in great condition. And again, we've had a good time getting to know the staff and the residents there. Here's another picture of the interior finishes. Okay, so it's a beautiful property, right? Good demographics. We don't have to do anything at this property. We could sit back, we could just let it ride. We could just kind of hope for the best. And we would probably get a good return if we did that. But at Great Capital, it's just not in our DNA. Since we did a lot of value adds when we were an early company, when we were starting, we still do value add projects. We understand the concepts of forced appreciation and looking for ways to add value. We understand the math and we understand what it takes to be competitive in today's market to attract residents. So we're going to do a couple of things. We're going to bring on some more money. We're going to make further investments into the property because when you're developing a new multifamily asset, especially in a period when costs are rising, you can't always do everything you want to do to be able to deliver it at a price where you think you can sell it. So, sometimes some like landscaping things get removed from the budget. There's a lot of wants, but they aren't always needs. Well, we're going to complete some of those things that are going to really improve the property, make it more attractive, but most importantly, drive revenue. So the first thing on our revenue enhancements is we're going to do what I call an amenity bomb value add. There's a great walking trail that goes around the property, around the large retention pond or lake at the site. People are using it all the time. We want to install more sitting areas, fire pits, and 2 additional grilling stations on the back side of the property. It's currently the only grilling station is by the pool and the clubhouse, and it's a good 10-minute walk from the back of the property to the front. So we want to be able to spread those amenities around the site, but also strategically place them on the tour path. There's a golf cart at the property. We'll take prospects around. We want to be able to pinpoint some of the enhanced amenities. And so when they compare flats at Stones Crossing compared to the competition, they're going to be getting so much more value at flats. They're going to be able to move themselves in, imagine themselves using these amenities, and also trying to get some of the current residents to renew, to say, look, I know you may be getting a decent deal on your rent right now because it was in lease up. We were going to increase your rents probably by about $80, but this is what you're going to get for that $80. You're going to get a new grilling station. You're going to get some short-term rentals that you can have your family stay in that I'm going to talk about in a second. We've got more sitting areas. In general, just better amenities, and we're investing more into the property. The next thing that I just mentioned is we're going to furnish 7 units. We've done this at other properties in the past, and it has been a huge success to drive revenue. We're averaging at our other sites around $1,000 of additional revenue per month from these furnished units. Now, we're going to do a combination of corporate rentals as well as short-term Airbnbs. We have an Airbnb operator we work closely with. This is a great utility, not just to drive revenue, but for when residents are on site. Let's say that something happens to their unit. God forbid there's a leak, because that happens, or someone's unit gets flooded. There's even maybe like a small fire. Anything that happens. Let's say that they miscommunicated with their mover and something's not ready and they need a place to stay. Well, we will have units available for residents to lease out, as well as if they want to have their family or friends, lease a unit. They'll be fully furnished to stay on site. But also, we're opening it up to members of the community. There are no real hotels in the immediate vicinity. And so we've had a lot of success in the past, and frankly, a lot of the residents, the clients, people that stay at these short-term rentals are on work contracts. So we're not typically having people stay for just 1 or 2 nights, although technically they can. It's usually folks that stay for a month or 2 at a time, a time period that is less than a typical apartment will allow them to rent for, but they need to stay in an area for 1 or 2 months, so they're looking for an apartment. So a great utility for residents, but also a great revenue driver. We're also adding private yards. We are budgeting $96,000, comes out to around $6,000 per private yard. And so we're installing new these black fences with turf. This is essentially extending the private space of the residents. So if they've got a dog, they can let the dog out onto the private yard. It's a huge amenity. Residents absolutely love it. We're targeting about $150 premium on those 16 units. We're also doing things to accelerate organic rent growth. We're using dynamic pricing and AI revenue management to spread out our lease terms and allow individuals to choose their move-in date and their lease term, and then we'll amortize any loss to lease based upon those choices. That's allowing us to get a couple more percentage points here and there, drive revenue, but also give optionality to residents. Looking at just a couple pictures of examples of some additional amenities we'd like to put in. Again, fire pits, little yard games, grills, hammocks. And here's an example of this isn't at one of our sites, but this is a similar example of a private yard at an apartment community. And we'll be doing, again, about 16 of these. Let's get into the comps. Let's talk about the competition. Maybe saying, again, what's the point? How are we going to drive rents? It's brand new. The rents are probably already really high. Well, it is brand new, and the rents are higher than the older properties that were built maybe in the 70s or 80s. But when you compare it to actually the properties that were built in the same year, Flats at Stones Crossing is actually a pretty good value and a little bit cheaper. It's cheaper than the Hangar on Emerson, it's cheaper than Timbers, it's cheaper than the Madison. By a couple $100. The highest comps, we're about $1.60 right now per square foot. The Madison is averaging about $1.80 per foot. Now, when we look at just the average of all of the units, Flats at Stones Crossing, as I mentioned, the average rent is about $1,600. On the highest end of the spectrum, it would be Redwood, Greenwood, which is just under $2,000. So that's that's about a $350 spread. And again, we have some other properties that are basically a $25 to up to that $300 difference. Most of the comps are about $25 to $75 delta. I like to think of it as about a $50 to $75 delta per month on average. That I think is just organically, day one, we can move our rents to match that competition. There's nothing special about some of these other properties. Looking at the one-bedroom rents, average is $1,400. The next comp is about $1,450. Two-bedroom rents, our average rent is about $1,750. Again, we have comps at $1,800, $1,825, $1,925, and all the way up to $19,750. So we get a good spread ahead of Flats at Stones Crossing. So when we've gotten pushback of, the rents are already really high, how can you grow rents? Well, organically, already are under market. Combined with the organic rent growth that's going on, then combined with some of our revenue enhancements that we're doing at the property, where we really are undercutting what our rent growth potential truly is. Looking at our three-bedroom rents, again, we're a little over $2,000. Redwood and Greenwood is all the way up to $2,200. And then the only other two properties that have three bedrooms available, the Hangar or Timbers, they're a little bit ahead of where we are, just right at $2,050. Talking about the structure of the investment, we like to keep things simple, just one simple class of equity. We're offering an 8% preferred return. That preferred return will accrue. We'll start paying 6% cash-on-cash returns, our projection, so that remaining 2% will accrue on your capital account and will be paid out as soon as we have that cash available. And that preferred return is paid before capital is returned and before the GP gets into the money on our splits as well. The GP's investment of our own dollars, cash into the deal, is treated the exact same as LP's, but we don't get into our carried interest or that split until preferred return is paid and 100% of LP capital has been returned. In terms of fees, we have an acquisition fee of 1.5%. That's based on the purchase price. A loan guarantee fee to provide a personal guarantee and originate the loan of 1% of the loan value. Then we have a property management fee of 3% and an asset management fee of 2%. And we have that low property management fee. In other syndication deals, you may not even see that property management fee because they don't manage their own properties. We do manage our own properties, but we also have a dedicated asset management team as well. I mean, both of those are taken as a percentage of gross revenue, not on invested capital. Distributions are monthly, and our reporting is monthly. The way we do our reporting is we do monthly like updates, snapshots with financials, but then we do a very robust quarterly report as well. That includes a video report for updates at the property. Now, looking at kind of the risks, flats at Stones Crossing, kind of what could go wrong. And this is relatively macro, and I'm going to dive into detail on some of these in just a second. I'm going to get into the investment on our actual financial model. But where flats at Stones Crossing kind of fits in the risk and return spectrum is really a core plus risk profile with value add like returns. You could even say that it might have closer to a core risk profile given the demographics, given the quality. But since it's technically secondary market, suburban in Indianapolis, it's in a path of progress. We won't give it a full core risk profile. But it certainly has the return projections and return profile closer to a value add than a core or core plus. We call this the efficient frontier. It's where you want to be, where you're getting a little bit of a higher rate of return, not taking too much risk. And this is exactly what we look for. But that doesn't mean that things can't go wrong. And I'm going to talk about some of those things that could go wrong, some of the reasons why we don't like the deal. First off, top of the list, somewhat limited highway access. Again, as I mentioned, it's between I-69 and I-65, but technically it takes about 10 minutes to get to either of those interstates. Now, we're right next to 135, which is a main corridor that goes right up to Indianapolis. That's the main retail corridor. One could say you've got great optionality getting to the east or the west side, going to I-69 or I-65, but that could be a drawback of just it takes about 10 minutes to get to either of those interstates. I think the biggest risk is increased rental competition. Now, again, there's no new multifamily plan besides those 280 units in the area, but with demographics like these, it would not be surprising. I mean, there will be more multifamily that is built in Greenwood, certainly over the next 10 years. Just the hard part is it's hard to finance multifamily properties, especially the equity side. Recently, we heard that there was a development that was attempted, but they couldn't receive the incentive TIF financing to be able to build that, which is good that Greenwood didn't issue those TIF dollars. It's good for our project because there's less competition. But at some point, someone will build more. Now, again, it takes 2 to 3 years to build a multifamily project, and when they do build that multifamily asset, they're going to be asking rents significantly higher than flats at Stones Crossing, and their overall cost of construction is going to be significantly higher than what we're paying for flats at Stones Crossing. So a little bit of competition can be good, and the way that we're projecting is that there will be a trickle of new competition over the next couple of years. There's not going to be a wave of new deliveries just because they haven't started those deliveries, and if they don't have the permits and they're not starting, we at least have 2 to 3 years before those come online. Again, we're anticipating the one project coming online, but we're not seeing really any movement on additional projects. So there could always be a severe economic downturn, depression, recession, stagflation. There could be a black swan event that really just tears down the U.S. economy. Now, we've seen multifamily really perform okay during recessions. We typically say that multifamily is recession resilient. It's not resistant. I mean, a recession isn't good for anybody or anything. Unemployment typically goes up, wages stagnate, and rents typically stagnate or even go negative during a recession. Now, that didn't happen necessarily during the last recession, during the pandemic, but typically that's what one would expect. Rising uncontrollable expenses. I mean, this is something that is more fresh to folks in the multifamily industry. We've seen insurance costs increase, property taxes increase, payroll, labor, materials, everything increase over the last couple of years. Most likely, those large increases are mostly behind us. We're actually seeing some year-over-year savings in some areas. We're getting insurance rates to come down. We're successfully appealing property taxes. And there's actually some exciting news on the property taxes at Flats and Stones Crossing I'll get into in a little bit. The The last risk is operational risk. The risk of gray capital and gray residential. We could mismanage the project. We could not perform. We could not hire the right team to be on site. The wrong leasing agents, the wrong property manager, and if that happens, then that's certainly would be on us, and is always a risk of who's actually operating that site. Now, we've got a great track record. We have great people. We have great teams, but things go wrong. And I like to think that we've earned our stripes and we get repeat investors because we have shown our ability to adapt in difficult circumstances and to find solutions and to figure it out. Again, we've done the bulk of our deals kind of through the pandemic and through a lot of uncertainties. We went through the whole wave of, kind of 2015 to 2022 of where it was, really easy to operate, of where you could buy a deal and, put some lipstick on it and you could sell it a couple years later. We've also lived through an environment where you couldn't do that at all. That business plan essentially went away and you had to adapt and act quickly. And again, we stopped doing bridge loans and short-term debt really before it was cool to do so. We've always been fixed rate finance guys, long-term holds, and we positioned our deals kind of ahead of time to avoid a lot of that risk. Again, we've never had to issue a capital call. We don't have to raise preferred equity. Maybe that's just because we're in the Midwest. Maybe because we try to, again, pay attention to the first and the second rule of preserving principal and preserving principal. Again, just never losing money. All right, cash flow on our base case assumptions with our business plan. Year one, we'll be distributing 6% cash on cash, looking to grow that to 6.9% by year two. By year three, our interest only period will have burned off, so that cash on cash comes back to 6.2. And then as we continue to grow rents, we're back to 7.2. In year five, we're able to achieve an 8.2% cash on cash return. Now, if your yearly cash flow, let's say you invested $250,000, that means you'd be distributed $15,000 a year, or $1,250 per month. Again, we do monthly distributions. In year two, you'd be earning about $17,000 a year, or about $1,400 a month. Eventually in year five, when we're cash flowing closer to 8%, it comes out to about $20,000 a year on a $250,000 investment, or about $1,700 a month on that $250,000 investment. All right, now I'm getting ready to get into Q&A, but before I do, let's jump into some sensitivity analysis. I'm going to get into the model. This is why many of you I know probably have attended, want to see us get into the deal and break it. So let's do just that. We have a variety of scenarios where we always are stress testing our model. Want to see where it breaks. That's what's fun. And this is our own proprietary model developed at Great Capital by our Chief Investment Officer, Jay Reeder, and our Chief Analyst, Addison Lubert. So we've got our base case on, or really what our business plan. And then we have several scenarios baked in with a variety of different outcomes, different rent growth scenarios, as well as different exit cap rate scenarios. Now, the returns may look a little bit different on this model than you've seen in your deck. And the primary reason for that is we're including the most up-to-date loan information, and as well as rent roll as well. So this is the most up-to-date. Good news on the financing front. We are hoping we will be locking in our interest rate this coming week, and it is much lower than we had anticipated. Right now, if we lock our interest rate that's indexed to the 5-year Treasury, we're locking in a rate around 4.77, could be up to 4.80. That's lower than we had anticipated. Again, that includes 24 months of interest only and a loan amount of $46,200,000. It's basically a 70% loan to value, and our going in DSCR is 127. So nice and healthy. So that projects essentially a what do we, IRR is a little bit different. What do we got going on here, guys? I don't know. There's been an update, so it should be a 17% IRR. I'm trying to see what, because this is I know this model very, very well, and it's showing a little bit better than it should. I wonder if something is updated. Okay. Well, let's just use it as a base case. If we change so we have four different methods to project rent growth, and that's based on here. Let's switch it over here. Either a kind of a base case, which is basically 3% market rent growth, a accelerated, basically like best case scenario, which is closer to 7%, which is basically what they did a year ago. Then there's kind of a worst case, which is basically not even keeping up with inflation. And then our business plan, which is starting at 5% and then dropping down to 4.5%. In the scenario where we have just base case rent, which is really just 3% rent growth. There we go. Now it's fixed. If we can only achieve 3% rent growth, and so we really fail at getting any rent premiums from our private garages, we fail at getting any organic rent growth besides like the national average. There's thousands of people that are moving into the area, no new supply, but we're still able to get 3% rent growth. The IRR over a 5-year hold period is just below a 13% IRR at 12.65. Now, if we have a down market, the cap rates absolutely expand, go out to about 6.25%, which if an asset like this is not traded for over a 6% cap rate, well over a decade. Well before I was in the business. If that happens, it wouldn't be good. I mean, this is basically, it's like we really can't grow rents beyond inflation, and cap rates blow out. The returns end up being a 7.8 IRR and a 1.4 multiple. So a 1.5 multiple on your money, 6% average cash on cash. So you'll get 6% kind of over the hold period. We're never able to grow out of that 6%. It's not a great return, but it's not a horrible return. It's basically you're getting that 8% preferred return over time. We'll be able to pay some of that preferred pref back. You'll get your capital back. Basically an 8% return. So not something that's really exciting, but again, this is a scenario where we've not really been able to grow rents significantly at all, and the market has decreased significantly. And that's a 6.25 cap rate. Now, if it's a down market, but we've still been able to achieve our business plan in terms of rents, wait for it to update. Oh, come on, Excel. There we go. Got it. So in the down market, we've got this 12.68. Now, if we're just let's look at a scenario where we have let's look at a scenario where, absolute worst case scenario, we're looking at it closer to, a 2.6 IRR. Now, this is where we can lose money. This is where it doesn't work. If we can absolutely never grow rents ever, we have expenses grow significantly, and we have to sell for a 6.25 cap rate, the equity multiple comes at a 0.8. We're unable to return everyone's capital. It's basically about a 20% loss of investor capital. There's some cash flow along the way, but it really doesn't make up for it. So in this scenario, we would not sell. We would not realize this loss. What we would do is in the fourth year before our loan expired, we would look to refinance. And we've stress tested a number of ways of where we would be able to refinance. We have put a refinance in month 60. We are able to get a little bit of rent growth in later years after that. And even in a down market, though, he'll change the term to 80. So let's say we get let's do a 10-year hold, 120 months. So in that scenario, again, even the down market, a 6.25 exit cap rate, we are looking at a 11.5 or 11.6% IRR. I'm in a 1.9x, almost a 2x equity multiple over 10 years. So that is scenario of which we're in year 4, we're looking at potentially selling, but the market is absolutely horrible. We're in the middle of a recession. Rents are down. It's just not a good time to sell. We would look to refinance. According to our stress test, we would be able to roll the debt into a new loan and extend the hold period. Now, there's another scenario. While even though we're planning for a 5-year hold period, there is a scenario of where the property is doing incredibly well. We are hitting all of our projections, and in consultation with our partners, investors, we decide we want to actually hold on to this property a little bit longer. We could refinance for an extended hold period with a plan of returning a significant portion, if not 100% of investor capital in year 5 and continue ownership. The real plan here is to return capital by year 5. But if all kind of stays the same, by year 5, we'll look at an exit, look for a buyer, and sell that asset, potentially in a portfolio sale, because we have multiple properties around Indianapolis, and that's always a possibility, but that's really not incorporated here on this model itself. All right, let me see if there's any other scenarios. Well, why not look at the best? We've looked at kind of the worst case scenarios. Let's look at a best rent growth scenario in just a normal market. When I say normal market, I mean a 5.5% cap rate, which is still a relatively high cap rate for an A-class asset. But if we are able to outperform our rent growth at a closer to 7% rather than 5%, keep in mind the average rent growth in the Great Capital portfolio right now is about 6%, so we're almost doing that in our own portfolio. Now this is over a 10-year hold. Here, let me take out the refinance and bring it back to 5-year hold. At a 5-year hold, slightly accelerated rent, but still 5.5% exit cap rate, we're looking at a 23% IRR. Now, just for fun, because I showed you, I'm only allowed to do this, I'm allowing myself to do this because I've shown you how we can lose money and that there's risk of losing money. Again, we've never done that. Do everything we can to avoid that scenario. But let's say that it's an up market. We don't go, now this is not as good as it was a couple of years ago. This is actually, we're using an exit cap rate that a deal in Indianapolis sold this year. So basically a 4.75% cap rate, accelerated rent growth. We're looking at basically a 28% IRR, almost a 30%, which it aligns with previous Great Capital projects. We've never underwritten a single project to be close to 28%. Typically, we're underwriting to kind of this 16% IRR range up to an 18. But we've been fortunate to either outperform. We've also had some help from cap rate compression on several deals, just to be honest. But in the event that interest rates do come down, like they are coming down potentially here in the near future, if interest rates come down over that 5-year period, not a whole lot of whole new supply comes online in the market, and we're able to see some accelerated rent growth. This is not an unrealistic scenario. Now, I'm not saying it's going to happen either. Again, our most likely scenario is what we've underwritten. It's our business plan with, I think, a conservative exit cap of 5.5%. And that delivers, the model fixed itself. I don't know what was going on earlier. That delivers, we're back to our 17% IRR at a 2x equity multiple with an average cash on cash of 7%. Again, we have a lot of different ways. Let me move over so you guys can see this. We stress test this model in a number of different ways. We have so many sensitivity tables looking at every different way we could potentially break this deal, looking at a variety of different scenarios. Because we're putting our own money to work, and we want it to be successful. And we follow the first rule, which is not to lose anybody's money. All right. Let's continue. And we're going to conclude here in just a second. So if you have any questions, start dropping them into the chat, and we will start answering them the best of our ability. Griffin asks, Spencer, is it worth discussing break-even occupancies in various rent growth scenarios? Yeah, let's look at some of the break-even occupancies. And I've actually got that pulled up right here. So break-even occupancy in year 1 is 74.1%. So that means basically we'd have to have our occupancy have to drop all the way down to 74%. That's never happened to any of our properties in our portfolio. We've had some properties dip in occupancy. Again, things happen. We have to accelerate, pivot, do different marketing efforts to get up there. We've been into the mid 80s before at some properties, but we've never been down to 74%. Year 2 drops down to 70%, all the way down to 67, 65, and up to 69 in year 5. So a good amount of headroom on our break-even occupancy. And then you'll also see on this chart is our exit cap rate sensitivity table, looking at a range between 4.5% and 6.5%. You see kind of our target right there in the middle at a 5-year hold period or 60 months at a 5.5 cap exit. Is right at a 17% IRR, 2.1 multiple. Now, if we sold it, a couple years late, let's say year 10 at a 6.5 cap, we're looking again at 12.47. And that's where really the range, I think really, if I was the true range of return in this deal, total return, IRR, is basically, I think, a 12.5 to a 28. There's a variety of ways I can see the deal, doing at least 17%. And I'm leaning towards is going to be closer to that 17, 18%. If things don't go well, the economy goes the wrong way, we really screw up, a ton of new supply is brought into the market, we could be closer to that 12 to 13% IRR range, maybe a 14% IRR range. But I'm leaning towards much more in this range here, kind of the 17, this 18. Again, we're going to be 5.5 is because we have to expand the cap rate a little bit. When we first were putting this deal under contract, it was technically close to a 5.25 cap rate. The revenue's gotten better, so it's now at a 5.5% cap rate. We're going to sell it in this range, the 4.5 to 5. That's my gut. I could be wrong. I can't predict the future, but this is where we're going to, based on housing demand, fundamentals in Indiana, but also the nation, but specifically the Midwest, accelerating employment, accelerating population growth, limited supply. We're going to be at least in this 5 cap range. And so when we're looking at that world, we're looking at a kind of a 16 to a 20. And again, we get 4.5, 475. We're kind of in a mid-20s range. And these are all based on our business plan and not any accelerated rent growth itself. All right, Tom, do you expect another syndication group to be your buyer at disposition? That's a great question. Potentially. Another buyer could be an institution. This is an institutional class asset. BlackRock is not currently active, or Blackstone is not currently active in the Indianapolis market. But if they do, or any other large institutions come in, this would be a prime target for one of those institutions. But also a large syndicator. There's several large syndicators, owner operators, buyers in the Midwest, especially in Indianapolis. This would be a prime target for them. And Indianapolis is a very liquid investment market itself. All right, if you have any other questions, let me know. And then, if not, make sure get in touch with the team. Blake, Peroni, Griffin, Haddad, love to schedule a meeting with you. I'd love to hop on a meeting with you myself. You can just go to the QR code to get access to that meeting. But also, if you're ready to go and you just want to get the materials to start taking a look at flats at Stones Crossing, the portal at Great Capital is open right now. We put more due diligence materials on our portal than I believe anyone else does. We like to be transparent. We want you to be able to do your own homework and research. And that's just the way we operate. So access the deal room. You can read through all of our inspection reports, all the physical inspection, financial information, go through all the partnership documents. But then also you can execute all of your deal documents, link your bank account, and fund your investment all in the same place. Again, it takes about 5 minutes, 10 minutes. If something goes wrong, if you run into an issue, just schedule a meeting with the team. We will walk through it step by step and get it done in no time. In terms of the timeline, again, we've been under contract. We're getting ready to waive due diligence. We're closing on September 29th. That is the plan. So in about the next 10 days or so, we will start calling capital. And again, looking to close near the end of next month. So you have a little bit of time, but if I'm being honest, And I'm not just saying this to create a sense of urgency. We're looking to finalize the fundraise this week. We have several commitments that are outstanding of totaling about $10 million. Now, we don't have $10 million left, all right? We have just a very small amount. Most likely will be wrapped up this week. We don't want you to miss out. It's an incredible deal that we're highly convicted of. We've never invested this much money into a single project. We've been waiting for the right deal for the longest time, for years. And this is myself, this is my team, this is also my family. So it's not just me. We've been looking for a suburban asset around Indianapolis that was built well, with great demographics, great incomes in the area, strong population growth, something that we would be comfortable making a big bet on. Now, we're not betting the whole farm on this one, but it is the largest single investment we've ever made into a specific property. Reasons: it's a great location, great schools, great demographics, great incomes. The submarket is just second to none. We've got moderate leverage, fixed rate financing, cash flow from day one. We know the market. We're local. We manage in the area. It's going to be part of our Indianapolis management pod. We manage 3, now going to be 4 other properties in the Indianapolis area. So it's going to be easy for us to do. It's in our backyard, and it's a stable cash flow from day one and strong risk-adjusted returns. We're highly convicted. We're excited about it. We can't wait to own this property, and we'd invite you to partner with myself, with my team, my family on flats at Stones Crossing. Again, scheduled meeting with Blake, Griffin, and myself. Hop into the Gray Capital portal to go through all the due diligence materials and get your questions answered. Praveen is asking, hey, Prov, how Gray Capital's vertically integrated property management team be directly involved in driving performance at flats at Stones Crossing? Great question. I wish I had, a whole another 30 minutes to just brag on our Gray Res and Gray Capital teams. Not just our on-site teams, but our entire portfolio specialists, our regional management team, and our ability to, quickly solve problems. Again, we've got a great technology stack. We use Real Pages, on one-site suite, as well as their AIRM, dynamic pricing models. But we have just an incredible team of portfolio specialists that have been helping us accelerate our centralization practices. And so we have the absolute best teams in the right positions where they need to be. If we have someone that, if we lose a team member, we have a centralized hub where we can surge that capacity. We also can do things remotely. So a lot of the work is done at our central office. So our on-site team members can focus on, human-to-human interactions, doing tours, working with residents, not busy doing admin work or bookkeeping or things like that. We use our best, have those folks, that all being done at our corporate office here in Indianapolis itself. But again, we've operated on the south side. Our team at Gray Residential has a lot of management experience on the south side of Indianapolis, and so it's going to be a pleasure to own and operate. Once again, hop into the deal room, schedule a meeting with the team. The minimum investment is $100,000. We'd love for this to be your first investment with Gray Capital. If you're in a recurring investment, we're excited to partner with you once again. Again, I'm hoping that you schedule meetings so I can meet you on one of these meetings. We're excited to close this deal, and we want you to be on the team. All right, I'm just going to give a minute to see if any other questions come in. I know it's 8 p.m. We're putting kids to bed, getting through dinner, and I appreciate everyone that was on the stream, everyone that was watching. It's been awesome. Just moved to just one more drone tour of the property. This is some of the new retail that's going. This is directly across the street. Brand new retail, new Brew Burger from Indianapolis. It's a Cunningham restaurant. There is, and again, if anybody wants to come do a tour, get in touch with Blake or Griffin. We'll set it up. All the retail that's going on in the area. I don't think we have really as good enough pictures, but it is exciting. You don't see this type of retail by accident. And with no other apartments coming on in the area, it's really, really exciting to see. And there's some of the upgrades that we're going to do. We're finalizing some of the plans with our landscape architect. You can see the nice pond here. It's almost like a lake, but there's this walking trail that goes around. And every time that I'm there, it's being highly utilized. And so we want to activate the trail, essentially, having things to do, places to sit, little Instagrammable spots to, enjoy yourself. Little areas, grass areas. You can see where we want to put little grilling stations or sitting areas. I think it's the details that matter, and it's what counts, and it's what may differentiate Flats at Stones Crossing compared to some of our competition. And it looks like Griffin's got a link to the tour, video tour. Awesome. Thank you, Griffin. All right. Well, I'm going to sign off. It's Sunday night. Thank you so much again for spending all your time here. I had a fun time. Hope you had a good time as well. Again, hop on, schedule a tour with us, and looking forward to partnering with you, Flats at Stones Crossing. All right. Thank you.